Well, the conflict in the Middle East has entered its 10th day and shows no sign of abating. Investors had hoped for a quick resolution, and unfortunately, the big question is how long this ultimately drags on. So far, there's really no signs of things clearing up, and because of that, we are seeing volatility continue to play out across global financial markets. Right now, the S&P 500 is off about 4% from its all-time high. It's actually faring a little bit better than overseas markets, which are don't have the benefit or the luxury of being net exporters of oil and are really taking the brunt of the damage. So the big question mark is how long this conflict drags on. When does that effective block on the Strait of Hormuz get lifted? For now, if we look at betting data, which is really all the rage these days, if you look at polymarket data, bettors are suggesting that there's a 75% chance that this conflict drags on past March 31st. And if you look at April, we actually see that it's a 50-50 shot that this conflict could actually go beyond April 30th. So obviously anything can happen. And if we did see a quick resolution, which we certainly hope we do, we would see markets stabilize. We might see a lot of those beaten down sectors and area of the market quickly recover. The longer this does drag on, though, that's where you really risk some long-term damage to the economic outlook and earnings projections as well, which I mentioned last week are so critical to our outlook and our positioning in portfolios. The best thing you can do right now is maintain discipline, maintain diversification. That's what we're doing in our portfolios, although we are watching things very, very closely. Really, the primary impact so far has been on energy markets. We've seen crude oil prices surpass $100 a barrel. They are up sharply from where they were just a couple of weeks ago. This has actually translated to the consumer already, where they are now feeling the pressure as well. If you look at gasoline prices, we see that the average price for unleaded gasoline in the United States is almost $3.50 a share. So that's up about 50 cents over the last week. It's about a 15% increase week over week. That is the largest weekly increase since Hurricane Katrina in 2005. So this is severe. As I said, if things are quickly resolved, we can see some stability come back. But the longer this drags on, that's when you really have to think about the implications for consumers, many of which are already feeling the pressure in this K-shaped economy, and the overall economy, which does rely so heavily on consumer spending. So this will start to impact confidence, start to impact inflation expectations, and might alter the appetite for spending on more discretionary items. So this is something that we certainly are going to keep an eye on here. What makes matters a little bit worse right now is that last week we got a jobs report that showed that the U.S. economy actually shed about 90,000 jobs in the month of February. So this was certainly below all estimates, where most were expecting the economy to add about 50,000. At the same time, we saw the unemployment rate increase to 4.4%. Actually, that's rounded. If you took the unrounded, it was 1/100th of a percent away from being 4.5%. So we were very, very close. We're starting to see some signs here of rising price pressure or inflationary pressure and evidence of a slowing economy. We don't want to get too wrapped up into one data point. This is just 1 month for the jobs market. But if this trend continues, we will start to hear more about the risk of stagflation, meaning a slowing economy and rising inflationary pressures. So that is something that if this conflict does drag on, it's something we can hear about and could put pressure on financial markets, specifically stocks and bonds as well. So I would imagine that's a theme that we're going to be talking about and keeping an eye on here in the weeks to come. Hopefully I'll have better news to share in next week's Market Outlook, but just know that we're keeping an eye on things. And as I said in the beginning, this is the best thing you can do right now is maintain discipline, maintain that long-term diversification. That's what we're doing for our clients. And I go back to that visual that we shared last week, which showed that this volatility that is caused by geopolitical events, it is often short-lived. This is very different than a financial crisis, which can really have more structural challenges for the economy. So that's what we're banking on for now. Of course, we'll be watching the situation as it continues to develop, but I'll leave it there for now. I'll look forward to seeing you next week.